Nilesh Shah joins us now, and he's delighted for a lot of factors. And he's delighted because I've been told that 2 days ago, the AMC which he manages, Kotak AMC, has reached a new landmark of 3 lakh crore. Nilesh bhai, good morning. What a fantastic achievement! What a fantastic achievement! Congratulations.
Thank you, Nikunj Pai, for inviting me over here, and thank you for your wishes. Clearly, this is reflection of investors' confidence and our partners' support.
How about saying something nice for media, Nilesh bhai, for a change?
Well, you have been always a supporter for mutual fund industry and Kotak Mutual Fund. And without your support, we would not have been able to reach out to all these investors day in and day out.
Thank you very much, Nilesh bhai. It's like I frankly look back from ET Now standpoint as a brand. We firmly believe that India is the land of opportunity, and if you just plan your asset allocation, a message which we always take out, you can reach your financial goals very, very smoothly. But Nilesh bhai, before we get into specifics of the market, let's look at the lay of the land. The lay of the land is equities are expensive. Bonds is a bad idea because interest rates will go higher. Gold is not going anywhere. And real estate, some would argue, depends on where you are, you will have a different opinion. What should one do in this kind of a market? Equities are expensive. Bonds is a bad idea. Real estate is a selective.
So, Nikunj Pai, you only gave the answer at the beginning of the question, a disciplined asset allocation. Equities are not very expensive, not very cheap. They are somewhere in the higher end of their fair range of valuation. Markets have corrected all over the world. We are still standing out. But I wouldn't say that our markets are looking expensive. I think we are fairly priced vis-a-vis our historical average in relation to global average. In terms of fixed income, yes, rates are rising, but to a great extent, our markets are currently discounting RBI's proposed action. And in our opinion, RBI will move in 3 stages. One, they will reduce reverse repo and repo rate corridor. Second, they will change stance from accommodative to neutral. And third, finally, they will move on repo rate hikes. Our markets have already discounted anywhere between 75 to 100 basis point of repo rate movement. So unlike global markets where people are waking up with their central bank's action, our markets are already discounting central bank's action. So selectively, there are pockets in fixed income where one can invest and which will be protected against increase in interest rates. On real estate, one will have to be selective, but after 5 to 7 years of stagnation in real estate prices, we think this is time to even consider investment over there. So net, please maintain the disciplined asset allocation, trust India growth story. And yes, there will be ups and downs undoubtedly, but if you stay invested, you will still outperform inflation and generate real return.
It's that time of the year where a lot of conversations would be centered around budget. And last year's budget, in a sense, has raised the bar and has changed the importance of budget because it re-rated the market. 2021 budget was a growth-dominated budget. What can be the different aspect of this year's budget? And for markets to stay where they are or even go higher, are there anything specific which could come in the budget which could excite the market?
So let me talk for the budget from a market point of view. Today, our trade, agriculture, private investment, and government spending are above pre-pandemic level. But the biggest driver for our economic consumption is below pre-pandemic level. Clearly, there is a need in the budget to support consumption, especially at the bottom end of the pyramid. We have seen what wonders Manrega has created in rural economy. Can we think of launching an urban Manrega solution targeted especially towards those bottom of the pyramid who has been impacted adversely by pandemic? The second thing will be to give tax incentives or some sort of support to housing sector. Housing employs maximum number of people. It has least import dependency, and some amount of nudge can create multiplier effect in economy. When Maharashtra state government gives stamp duty concession for a while, it really preponed purchases of housing and helped liquidated inventory. We can think of variety of things to support housing in the budget, which will create multiplier effect. And again, bottom of the pyramid will get employment. In this world, if you don't speak about environmental, social, and governance, then it's difficult to maintain your premium valuation. I expect budget to stress how India is encouraging ESG across not only its corporate entities, but also across the country. We are the only country in the world which has achieved their Paris Accord target of 40% renewable power. The final thing will be, Nikunj bhai, related to Jan Nivesh Yojana, similar to Jan Dhan Yojana. Jan Dhan ensured that crores of Indians who didn't have access to banking system were having bank accounts. Now we need to shift from bank accounts to investment. To give you a small example, Indians have imported in this century alone, just 21 years of this century, $433 billion of gold. This is, Nikunj bhai, net import after making an assumption about exports of gold jewelry. When this $433 billion has been paid in foreign exchange, it has led to our outflow of savings from India to other countries. This is more than what we have received in foreign direct investments in last 21 years, or what we have received as foreign portfolio investment in last 21 years. We are a net exporter of capital when we desperately need money to make investments in our own country. Now, how do we shift people from buying of gold to buying of financial product? We have to make buying of financial product as simple, as easy as buying of gold. We have to educate people that gold is not the panacea for your savings and investment solutions. There are also other options like financial products, from mutual funds to insurance companies to bank deposits. So if we can create a budget which is pro-growth, which supports consumption, which encourages domestic savings to fund domestic investments, and which talks about environmental, social, and governance initiatives of the government, I have no doubt that we will be able to maintain our premium valuation.
Good morning. This is Nayantara. Great to have your budget expectations and, in a sense, set the tone at a time when, of course, you've shattered a record at the AMC as well. The other thing I wanted to ask you, and just picking up from what you were just telling Nikunj, for the first time in 10 years almost, it seems the profit pools are real, that we are seeing a reversal in the capex cycle. You're seeing excitement when it comes to textiles, to manufacturing. The government is also, of course, responding with production-linked incentive schemes. How are fund managers like yours reacting to that?
So we believe now there is a renaissance in Indian manufacturing sector. We have discovered the winning formula for manufacturing. In the 80s, India and China were of similar size in GDP and per capita GDP. Today, they are 5 times bigger than us. While we succeeded in becoming back office to the world and pharmacy to the world, we couldn't become manufacturer to the world like China. But examples of mobile phones and room air conditioner sectors in last couple of years have shown how we can create winning formula in manufacturing sector. In mobile phones, we allowed 100% FDI under automatic route. There was phased manufacturing program. Then there was electronic clusters program. Then production linked incentive scheme came. Then there was red carpet welcome to global manufacturers like Samsung and Apple suppliers, Pegatron, Foxconn, Wistron. And we also gave import duty protection for manufacturing in India. We leveraged our large domestic market to lay red carpet for global manufacturers. In FY 2014, our mobile phones manufacturing value was about 27,000 crore. In FY21, it is roughly about 2,20,000 crore. In FY15, our import of mobile phones was $8 billion. In FY22, we are likely to have net export of $5 billion. Apple and Samsung both have achieved almost 100% plus target of their PLI target against $2.5 billion. Their manufacturing will be about $5 billion. Now, we know how manufacturing sector can expand through experience in room air conditioner and mobile phones. This needs to be replicated in other sectors, in agriculture, in textiles, in soft toys, in bulk drugs, APIs, footwear. There are so many sectors where India can play an important role in manufacturing. We can be part of global supply chain management. We can increase our exports market share. So we know the formula. Now we just have to execute on the ground.
So we know the formula, how to become Atmanirbhar, how to have a China plus strategy, and trying to get global giants as well as Indian giants to manufacture more from the country. Given that backdrop, Nilesh Bhai, what I want to also ask you is, and from the market's perspective, would this also therefore be a time then to have a portfolio that is more biased towards playing the capex cycle, whether it is through textile stocks, manufacturing stocks, banks, deep value stocks, versus what the noise really has been about in 2021, which could be the new age companies or IT companies that have also seen a run up?
So undoubtedly, we think in the technology sector also, or outsourcing sector per se, including technology, pharma, chemicals, they will continue to grow their business. But there the valuations are expecting a tier away growth. And we believe midcap IT companies may not witness a price correction, but certainly they will witness a time correction so that fundamentals can catch up with the valuations. Today, midcap IT companies are trading above large cap IT companies because of the growth expectations. In case those lofty growth expectations are not met, there will be a time correction. The second thing is related to capital goods and industrials. We believe capital goods and industrial sectors, after a hibernation of almost 4 or 5 years, is poised for good days ahead. There are sectors like cement, steel, sugar, where capex cycle has begun. Government's infrastructure spending has increased. The exports opportunities are also coming through. And most importantly, most of these companies in capital goods sector have operating leverage. They have cut costs, become more productive. So we believe there is a slightly birbal ki khichdi type multi-year cycle. It may be slow in the beginning, but will pick up the pace at the later date. And capital goods and industrial companies will have a couple of years of above average growth and margin expansion. Now, as I again say, operative word is birbal ki khichdi. It will start slow and then it will gain momentum. But as a fund house, we have been overweight industrials and capital goods. We are also in the process of launching a manufacturing fund with the hope that this renaissance of manufacturing will be captured in our portfolios.
Nilesh, you've always had a knack for coming up with the most creative ideas and analogies. Apart from the points that you already mentioned, how else can the budget really push consumption further?
So there are two ways to push consumption. One, let's call American way, whereby they started giving so much tools to their citizens that many people stayed at home rather than work in a low-end job like flipping burgers at McDonald's because they were getting more allowance sitting at home. Now, that is possible for a rich country. For a poor country like us, that is not the solution. We have been providing food grains to 80 crore families. I think if we can create an urban Manrega scheme, which is targeted towards school bus operators, which is targeted towards people in film and entertainment industry, which is targeted towards employees in restaurant and hotel industry, my feeling is that this will support consumption. This will give breathing space to this people, and they will be able to, eventually get adjusted into the mainstream economy. So one is kind of using surplus labor to build urban infrastructure like we are doing in rural infrastructure. This will definitely support consumption. The second thing is to actually encourage industry so that we can create a virtuous cycle. Textiles, automobiles, housing, and construction. These are three large industries which employs lots of people. Now, in automobile today, there are limitations in terms of giving incentives because of raw material shortages. Housing and construction is least import dependency. And hence, if we encourage housing, then it will start creating a virtuous cycle where there will be more demand for house, they will employ more people, and they will go and spend money on consumption. So either we give money to the bottom of the pyramid, or we encourage industry which employs bottom of the pyramid. That combo will create solution for consumption and take it above pre-pandemic level.
Sure. You know, the other thing, Nilesh, which continues to loom large is Fed tightening. While there is clearly no way of predicting that, do you sense that it's inevitable that some of the money will pull out if that were to happen sooner than anticipated?
So will there be temporary effect of Fed tightening? Answer is undoubtedly yes. But there are two ingredients to Fed tightening. Is Fed going to raise more than 3 times what is discounted in the market? Will those rate hikes be front-loaded rather than evenly spread? Both those factors, the trajectory of Fed rate rise and the front-loading, will have impact on our market. The second thing is also our own growth potential and positioning. If Fed tightening happens, let's say, at lower than current level of the market, the impact will be far less. If it happens 10% higher than the current level of market, the impact will be far more. So our valuation and our expectations also will make an impact. But at the end of the day, I think investors will remember what John Chambers, ex-chairman of Cisco, mentioned. If I have to bet upon one country in Asia, it is India. If I have to bet upon 2 countries in Asia, it is India twice. So there will be temporary effect of Fed rate depending upon front loading, depending upon trajectory of Fed rate increase, and depending upon our valuation. But at the end of the day, John Chambers' words will prevail.
So, Nilesh, if there is one category which one should bet on in terms of risk reward ratio, volatility, valuations, should it be the balance category? Should it be the equity diversified category? What is one category which one should look at?
So, Nikunj bhai, for a customer or an investor who wants fill it, shut it, forget it, the solution will be asset allocator fund. In our Kotak asset allocator fund, we divide depending upon the relative valuations between equity, fixed income, and gold. Whereas in our balance advantage fund, we divide just between equity and debt. So for an investor who doesn't want to get into the nitty-gritties of asset allocation and wants fund manager to do that job, an asset allocator fund or a balance advantage fund will be appropriate. Now, please appreciate it that these are not the funds which will outperform small cap equity on the way up and outperform fixed income on the way down. These are asset allocator funds. They will always try to optimize risk-adjusted return for investors.
Let's leave it at that for today. It's been great to have you on the channel, sharing all of your views and the big themes that you're watching out for in the run-up to 1st February.
Thank you.